I'm here.
Okay, yeah, I think you do.
All right. Well, I know it's pretty late over there, so we try to be nice. I'm Ali Najat Malayeri. I'm a finance professor at the University of Wyoming. And I'm the co-chair of the Decentralized Treasury Working Group at Begin. It is my distinct pleasure to have with me a distinguished panel of experts today, this morning, or wherever you are in the world. And we're going to be talking about all things stablecoin, DeFi, and of course, banking crisis, crypto winter, and everything else. This last year obviously has been a very exciting, to say the least, year for stablecoins. Starting almost a year ago with the collapse of Terra Luna, followed by Binance forced conversion of its stable coins, then the FTX collapsed, and more recently Silicon Valley, Silvergate, and just a week ago, or maybe not even that, First Republic collapse. I hate to tempt fate, but I guess we can safely say whatever could have gone wrong, it's gone, except the big unknown in the room, which is the regulators. So without further ado, in this sort of a exciting background, I'd like you to join me, welcome our panelists, Caroline Hill from Circle, the power behind USDC, Yuko Kawai from Japan Digital Design, and Filippo Saravania from Aircash. Hopefully I said the names correct. So with that, I'm going to start with Caroline. Last year, when we first started talking about stable coins, things look really good, especially for USDC. The collapse of Terra Luna kind of puts a light on the fiat-backed ones, and ever since there seems to have been one after another crises that has pushed stable coins to the limit. Could you please give us a rundown of what has happened, where Circle stands in the middle of all of this, and what does the future look like, especially for Circle and other stablecoins?
Sure, absolutely. Thanks, Ali. It's good to see you again and be on a panel with you, and thanks to the Begin team as well. Well, I can safely say that you are tempting fate. I hope that nothing else goes wrong. But frankly, you have outlined a number of things that have happened over the last year that have been both crypto and financial sector related. And so that's where I'll start. Maybe I'll start on a more down, a few more negative points and end on some higher points. Since Terra Luna, since really the emergence of digital assets for so many use cases and payments use cases, and other secondary use cases, in the United States and worldwide, regulators have been looking at the financial stability risk and the market risk, anti-money laundering risk, really how this sector can operate safely and be brought into the regulated atmosphere. And what we have seen recently, which I find very interesting, is that the failure of several banks here in the United States were not actually caused by crypto-related problems, but caused problems in the crypto sphere. And what do I mean by that? Well, first off, we had 3 banks, all of which who had crypto customers, fail in a short period of time. But that was due to larger issues with their liquidity management and their solvency, and not a direct result of their clientele. And in fact, I love to note that those banks were offering unique services, which is why so many crypto were using those banks to begin with. They were offering 24/7 settlement services that so many people are demanding, and that's why they moved to digital assets to begin with. So in this downward spiral of several banks failing over a short amount of time, kind of a black swan event. Circle was not immune from the challenges that this caused, and I think as probably everybody in the room and on the line knows and understands, we saw a temporary depeg of USDC on the secondary market during the weekend period, where it was unclear whether SVB, Silicon Valley Bank, was going to be put into receivership by FDIC and the deposits bailed out. This was a result of again, depeg on the secondary market. Customers were still redeeming from Circle 1-to-1 and still had that ability to. And, somewhat ironically, I think stemmed from Circle's utmost commitment to transparency during this time, where we, as we always have with our reserves, voluntarily and publicly identified that some of our cash reserves were held at SVB. We also saw a recovery of USDC's peg to nearly $1 when we announced that we were going to be taking company funds to cover any lost deposits. And then, of course, when the Treasury Department and the Federal Reserve announced that they would cover the deposits at SVB, USDC recovered back to the $1 peg. But taking a step backwards, there has been that. So that was a unique aspect. Like I said, regulators have been concerned about the effects that crypto would have on banking, and here we saw actually that when you are able to fractionally lend out commercial bank deposits, that has second order effects, and in this case on crypto. But in other regulators here in the United States, the Federal Reserve, the OCC, I think in really a response to FTX, have continued to clarify their guidance on how the formal financial institution can interact with crypto. And I think a lot of that has centered around the relationship that stablecoins have with TradFi, given our stablecoins' role in being that bridge between TradFi and the digital assets ecosystem. I think that I think we'll talk about this a little bit later, but at least here in the United States, what we're desperately missing is a broader prudential regulatory framework that has to come down from Congress. And until that point, we'll continue to see guidance and kind of limited rulemaking from U.S. regulators without really addressing the totality of the market in a way that the EU has with MiCA. But I said I would finish my introductory remarks with a little bit more of a positive note. We are still, despite this crypto winter, some call it the crypto ice age, we're still very positive and excited about the future of the USDC economy. And we're still spending a lot of time and effort to expand USDC's global reach. For instance, we've recently announced that we are expanding into the EU market as licensed and applying for French licensing, which will come into effect under MiCA as well. We have in principle licensing from Singapore. But even more fundamentally than that, we're continuing to look at how to make USDC accessible on more wallets worldwide. Just last week, we announced a USDC cross-chain transfer protocol, essentially a USDC bridge from Ethereum to Avalanche, where you can transfer USDC directly between the bridges without using a third-party bridge, or directly between the chains without using a third-party bridge. And we're also working with new and innovative partners to really demonstrate the value of USDC. For instance, we have partnered with the UN to disperse USDC to internally displaced persons in Ukraine who are fleeing the violence after the Russian invasion. They're able to take their USDC and cash out at any MoneyGram location worldwide, providing a safe store of value and one that's incredibly mobile and secure. So despite this winter, this ice age, and whatever future comes that Ali just jinxed us on, I still think that the future of USDC and that economy looks very strong.
Well, thank you. I didn't mean to jinx anybody, but as the black sheep of the group, I got to live up to my reputation. Now, with that, of course, let me circle back, pun intended, to Yuka. Yuka, you've been involved with financial services, central banking for quite some time, and now with JDD. You obviously have a very unique perspective on how the links between TradFi and DeFi works. Given all the developments in past year, is there a specific lessons that we could carry from TradFi to DeFi? So, for instance, I'm of the belief that, the recent failures are basically at its core a risk management failure. The banks could have sort of installed old-fashioned, very well-known, well-documented interest rate risk management mechanisms, and they just failed to do it. Are there any lessons that we could sort of carry from TradFi to DeFi, or are the unique aspects of DeFi that could mitigate some of these risks, or at least make the management of them easier, more efficient, or anything like that? Please.
Thank you, Ali. Thank you very much for having me on this panel, and thank you very much for a very difficult question. Because over the series of the events we observed in the past couple of months, not only myself but also many people should have thought that, well, this is what we've seen before, right? This has been, well, what happened very recently, as Caroline mentioned, it was a spillover from TradFi to DeFi. But what happened in the DeFi world by itself is the people have started, the holders of tokens have started like losing some trust, or has casted some doubts over the credibility of the collateral, which was held by held on behalf of the holders of the coin, on behalf of the tokens. I mean, it's nothing but the losing face in some of the credibility of the issuers, or either in the issuers or the credibility, which is really close to the classic background problem they observed in the TradFi world many times in the history. What's different this time from the last time was of course the linkage between TradFi and DeFi is one of them, but also the speed of the risk developments. I mean, because of the online nature of the transaction, it happened almost instantly in comparison to the past. I mean, in the crisis in the past in the TradFi world. And in the long history of TradFi, we have been facing many financial crises of this sort. And countermeasures have been built over the period. I mean, it wasn't built like overnight. It was just it was built like it had been built over the period of a century, I would say. So the very recent collapse of the traditional financial institutions, including a sizable ones in Europe, and of course a couple of them in America, has met almost immediate support from the regulators, central banks, and the industry. Therefore, has not developed into the large turmoil. The environment today is quite different from what we had 10 years ago when Lehman Brothers collapsed. We have much less leverage, much less ambiguity, more shared information, and more capital and public attention to support the temporary disruption of the trust. The improvements of the environment and the layer of countermeasures taken to suppress the crisis developments this time, well, it seems to have worked very well, but it of course bears a cost. So in the DeFi world, in the DeFi world, we know, I mean, we learned from this time, and also we know from the beginning that it has less layers in comparison to the TradFi. That means that it may be more vulnerable to these risks because there are not many intermediaries who are trying to stop the crisis spread. And also there's no backstop. There is much less backstop in comparison to TradFi. In the TradFi world, I mean, central banks and regulators are standing behind, and it has been fortified, as I mentioned, through from the experience of the past, through the many of the banking crises we had in the past. But the DeFi does not have that. So I really do not have the conclusion now. Like the stability of TradFi has been achieved. Achieved through the many measures we have like crafted in the experience of the crisis. But do we want to build the same thing for the DeFi? I'm not quite sure, because it really bears a cost. I mean, it really ruins the speed and the usability of the tools we use for the financial services. The technologies may work, and at least in terms of the information sharing part, which was completely lacking in the crisis of the Lehman Brothers and in the many other past financial crises, can be improved and can be perfected, can be improved by the technologies, I'm sure. Clarity is there, much more clarity is there in comparison to TradFi in the word DeFi maybe. But I mean, that's the only thing I can think of at this moment, and I'm really willing to listen to the thoughts by others. Thank you.
Thank you. Super. Fantastic. All right. Well, Philip, as the head of digital assets for Aircash, you're at the forefront of the payment revolution, or digital payment revolution. Given the crypto winter or ice age, all the turmoils, how has life changed for you? There are some positive developments in Europe with MiCA and other things. Obviously, U.S. Remains very hostile. How is DeFi ecosystem in Eastern Europe? What are the positive pockets? What are the challenges?
Well, Ali, thank you for the question. I hope you can hear me all. So basically, I'm pretty new at Aircash. I came here during the crypto winter because I was for 10 years regulator, and I decided that crypto winter is the right point in time to try to develop some new products. So coming back to your question, well, it's interesting to have panel discussion with someone from US, because we can always see headlines around crypto, how the US is very hostile regarding the regulation and so on. But watching that from the European side, where we have the so-called market in crypto assets regulation now, not still in place, but it's the parliament and the council are formally approved that regulation. So it's pretty straightforward what will be the future of stablecoin and crypto markets in general regulation in Europe. But we don't have so many market developments regarding your question. So I always remember one joke from another panel when someone mentioned, if we are talking about fintech and generally technology, and then someone from US says, okay, we are bringing the software to the party, and someone from Far Asia comes and tells, we are bringing the hardware to the party, and then someone from the EU comes and tells, hey, we are bringing the regulation, and everyone runs away from the party. So that's how this crypto market in EU sounds to me, because we have pretty solid regulation, but not really developed stable coins, not large DeFi teams like worldwide. If you watch MakerDAO or Aave, they are all originally EU based, but they moved to the US or London or somewhere outside of the EU. Well, maybe the very reason for that is because we put regulation too early into the place without letting markets to develop to some size, and we are waiting for the legislators to tell us how to do things. And for example, for the Circle case, despite the fact I was personally involved with my little holding of crypto basket and just watching what's happening on the markets during the MiCA negotiations, I have the opportunity from the expert side in European Council to work on MiCA. And what I don't like is basically we just copy paste the traditional electronic money regulation, electronic money license. Tell me if I'm wrong. I believe that US regulation is a little bit different. You have a money transmitter. It's similar, but not the same beast. And we just copy paste that to the so-called D-money token, to the stable coins denominated in fiat. And I don't know what is the better option, but I believe that that USDC case show us that we can't really just copy paste that regulation. Why? I'm not familiar. Is there any e-money at this point of time? Every e-money ecosystem is really like walled garden. You know, communication between the capital markets and other e-money providers is much slower. The settlement is like traditional finance settlement. The e-money is traditionally used for pretty much different purpose than for capital markets purpose or DeFi purpose, which can like compare. And it's not 24/7. It's not so many speculators. It's not so market oriented. From the stablecoin side in crypto, everything is happening really fast. It's basically like a forex market with multiple trading pairs all across the globe 24/7, and many retail people just holding that money, that stable coin at the point of time. What I want to say, just copy pasting the e-money regulation and try to and telling that everything will be safe from the side of future stable coins denominated in fiat. I'm not so sure that it will go really smoothly from the resilience side of future depeggings. Even though to be more positive, it's great that we have the opportunity to break down those walled gardens, like have a market that is really interconnected, that we can call legal money, and that is really fast, and settlement is happening non-stop, because we can see the real market price of someone tokenizing some real world asset as USD dollar, and we can see the real market price in every moment of his how to say counterpart risk, basically. So when the market participants saw that something is happening with one of the banks that Circle is holding money with, market just really fast make a new market price of this, basically Circle's risk. And you don't see that in traditional finance because you are in the walled gardens, and maybe that opacity of traditional finance is keeping us safe, but it may be just keeping us in the dark for the longer period of time. So I'm looking forward to Circle coming in Europe, and I'm looking forward to see how their project will develop in the European market under the MiCA regulation and in-money regulation.
Fantastic, thank you. Well, let me, since we got into some of the macro discussions, let me throw at the entire panel a loaded question. So, you know, in this background, we've got a rising inflation. We've got central banks that are trying to combat inflation by raising rates, and perhaps that has played a significant role in the travails in the banking sector. But you know, this is just part of a picture. You know, Goldman Sachs had an announcement not a month ago that their partnership with Apple was less than desirable, to say the least. And then you know, maybe a couple of weeks ago, Apple came up with their high yield deposit accounts, and in one day they attracted more than $1 billion deposits. So I guess where I'm heading is something like this. The banks have been trying to figure out this platform economy, this digital economy, trying to find a place for themselves. And perhaps in so doing, also whether very outright or a backhanded way, fight with DeFi and all the other digital competitors. To me, however, at least from the Apple experience, it seems like the big 800-pound gorilla in the room, Apple and likes of Apple, who have already developed a network that access 2 billion plus human beings on Earth, have an established sort of asset that it's almost impossible to replicate. Do you think I'm correct in that or not? If I'm wrong, and there is a way to compete with someone like Apple, what are the pathways? If the outright competition is not the way to go, then what are the ways with which DeFi can carve a path forward? And it's an open question to the entire panel.
Could I start? Thank you. That's a great question. And that's a question I've been asking myself for the past 10 years, actually. The past 10 years means that that's when the Alipay and WeChat Pay in China, the big two big tech companies took seizure. I mean, they massively and quickly developed the massive payment platforms out of blue. And even though the Alipay was the background, the great e-commerce platform, and WeChat Pay was the great background, the social social network of the nationwide messaging services, the introduction of the platform, the payment platform into their business model has been dramatic, and I think that their success. I'm not quite sure about the ultimate goal of the Apple, who to me, I mean, the Apple seems to be quite conservative and reasonably conservative about utilizing the data of their users. On the other hand, the success of the Chinese two platforms came from the full, maybe more than full usage of the big data, which was collected from the retail users, which they have gathered around their two gigantic the platforms. And whether it's possible for the existing financial institutions to create and own and operate those platforms, I don't think that's the solution for I don't think it's possible. The only reason why they are successful, I mean, those big tech companies have been successful are those are the multi-service platforms, including the service and non-financial, including financial non-financial services, and was the massive, as I said, it was the massive user population. I mean, the only with those set up, the utilization and the monetization of the big data is possible through those big platforms, and people will be attracted to those platforms. And very recent, the wave of the Web3 discussion is nothing but the it's maybe the move against those like Web2 type of big platforms, but I mean, I don't know whether it's scalable. I don't know at this point the Web3 is scalable or not. The only way I think of like making a success in those avenues is like more fragmented way that we think about the globe, like if we put like too much power into the platform economy, was maybe like Apple is coming in that way. It's the people who will be feeling like uncomfortable against those platforms and going to the more fragmented way or not. But it requires the literacy, so-called the literacy on the user side, because users need to protect themselves individually. So I don't have the answer at this moment, but the Apple's way, if they are going into the way that they're going to fully utilize the user big data, the no traditional financial institution stratifieds can compete against them.
Thank you. Philip, your perspective?
Well, we are e-money operator with digital wallet, and of course that our reach from the European perspective and European license can be as big as someone from the big tech. But not mentioning only like successes of the big tech, we can mention many failures of big tech companies trying to enter the global financial market, from Amazon, from Facebook, few examples. So maybe the Apple Pay and Google Pay are good examples, but we will see what will happen with these savings accounts from the if we are talking about regulatory business, it's not so easy to develop scalable one-size-fits-all financial product all across the globe. They maybe have 2 billion customers of their mobiles, but financial product and savings accounts are something very different. I don't know the exact legal setup of their offerings with Goldman Sachs. Is that some kind of I don't know, collective investment undertaking, money market fund in behind of that, or just like banking savings account deposits? I'm not aware of that, but you know, if you want to offer that in European Union, Australia, Japan, all across the globe, I know they have money, they have resources, but who knows? Web3 and DeFi can much easily, for now, enter especially markets which are not so much regulatory closed, like Africa or South America and so on. And like if there is a real usage, and if there is really like what is the real pain in DeFi, maybe user interfaces and so on, I believe that some maybe not developed countries, not developed markets can really be easily penetrated with DeFi, new DeFi products, and users can onboard on them. And on the other side, at least from my limited knowledge, Apple users are more from developed countries. Like you must afford yourself iPhone if you are from some third world country with not such good personal income. You can't really buy yourself maybe a new iPhone and open savings account with Goldman Sachs. But if you are from Europe, I don't know, they don't have a license, at least for now, as far as I know, for that product. So
Thank you. Caroline?
I agree. So I'm just going to add on to what Philippe and Yuko already said. I mean, I think the exciting thing about Web3 is the optionality, and DeFi is one of those examples where anyone can build on chain and provide, in my view, really democratized financial services that we don't have broadly in the United States, and we don't have broadly across the world. I mean, the traditional financial system was really built for a small select group of wealthy investors, in my mind. And so being able to have developers around the world build for their specific use case, I mean, it's difficult to replicate that in you know, by even one of the largest, most profitable companies in the world, because they just don't have that reach. And I also think, you could, to your point, we've seen a very clear, both at the government level and at the retail level, shift away from or demand for data privacy. Obviously, we saw that with GDPR in the EU, and you know, I think that's one of the other exciting things about Web3 and digital assets and DeFi, is that ability to control your own data. And so I think there's still a ways to go on how to ensure data privacy in financial services aligns with regulator priorities for AML and other such compliance regulations. But I think that there are brilliant minds building that type of capability. And once that's a, you know, once that has reached that that utopia, I'll call it, that utopia of being regulatory compliant and protecting data privacy, I really think that it's going to open up and a wide array of products and services to people all over the world who may not have access to Philippe's point, may not have access to the App Store or an iPhone, but may even only have access to a cell phone without those capabilities. So very feeling excited about kind of this, again, not replacement of the traditional financial system, but optionality that's being developed.
Thank you. I think Massimo is also on our panel, but I don't see him on the Zoom, so I'm assuming someone.
I'm too near probably to be visible.
All right. So I guess same question for you, since your keynote was about CDBCs and everything else, digital money. What's your perspective? How does big tech with their capabilities fits into the big picture, if anything? I admit that there's Chinese example that has been very hostile towards their big tech becoming also a big financial service provider. But then in the US, they seem to be more comfortable with the big tech than DeFi.
Yes, no, I think that somehow we are in a context a little bit as we are seeing now also with some troubles in the banking system, which we tend to be very conservative when it comes to financial services. If you think that the way we addressed the financial crisis for several years was not really changing anything fundamentally the way finance was done, but actually creating layers and layers of regulations, layers of capital that in a sense, paradoxically, it was probably a mistake to lower some of the requirements, a few years ago, and we will see the consequences. But it's also true that the regulation that we put during the financial crisis were really stifling the system, and its innovation. And I'm not talking about financial innovation. I'm talking a little bit of business model innovation. But what I can see is a very fluid situation, because as it happens many times, 3 months ago, everyone thought that the problem were cryptos. That was strange, because 2 years ago, thought that cryptos were the solution, and the financial system was actually the problem. Now we realize that there are some problems in the traditional financial system, in the banking model in particular. And if these problems persist or repeat themselves, we will become less conservative and we will see more changes. One thing that I want to point out about, for example, stable coins, I find it a little bit, inefficient at system level, that we have something like stable coins that are full reserve, which is the original form of money, that in a sense, however, we couldn't even call full reserve, because as we have seen, a part, for example, of the reserve of USDC was in a bank. And this meant that behind that, there was the banking risk that is not full reserve. But in principle, on one end, we have something like stable coins that are full reserve, and on the other end, we have money issued by banks where the reserve can be as low as 3 or 4% in US or European jurisdiction. And my question is why we are not seriously thinking of something individual, So why USDC is required to have 100% reserve, which is actually really extremely conservative, while instead commercial bank money can run on such a lower reserve. I find this contradictory, and I think that we are probably near to the point in which this aspect will be rediscussed, and it's probably about time that this happens.
You raise a very good point. Circle has always operated in holding USDC in full reserves, but as you said, 20% of our reserves are cash, and those are held at U.S. financial institutions who lends out that cash. And while we maintain our own diversification of where we hold that cash, it's still vulnerable. And so it's something actually that we've been even more outspoken on recently about the need to be able to access central bank services, particularly for cash reserves, but for the other financial stability benefits that central bank services offer, in order to mitigate that risk. That's something that needs to come through regulation. But I think if regulators are serious around minimizing those financial stability risks that are cross-sector from digital assets to TradFi and vice versa, it's something that they should seriously consider and open up a pathway for.
Well, thank you all. We promised, to stick with our allotted time of 45 minutes. We're at the 45-minute. So I guess I'm opening up the floor for, questions from the audience to our panelists. If there's no question, I'm going to make this stuff up right now.
Ali,
Yes.
I have a quick question because the purpose of this roundtable is finding new work item happening by stakeholders. And so before this, just after that Silicon Valley Bank case happened, so we started to create that document on the potential points of failure for stablecoin, because at that time, so we found that blockchain would like to eliminate the single point of failure from the payment system, but we find that the traditional bank is a point of failure of stablecoin. So this is the reason why we started that. So there are many hidden point of failure there in the world of stablecoin, and let us list up that what are the hidden single point of failure in the world of stablecoin, and what is the priority we should tackle with. So for example, we should point out, so number 1, 2, 3 important points of failure we need to solve. And so my question to the panelists is, what is the very important points of failure we need to solve or we need to eliminate from now? And so this is truly the important future works at the beginning to create some common solution by stakeholders. This is my question. What is the prioritized points of failure we need to think?
So, but I guess obviously I'm not the expert here, but there is a talk tomorrow that we're going to address some of that and add some of the things that Caroline talked about and other people have talked about, which is up until recently, I think the idea that if you hold 100% reserve, there shouldn't be any counterparty risk. The problem is that when you hold reserve in someone else's bank, there is a weird third-party risk that shows up as a counterparty risk, and you have no control over it. So, how do you solve that? Well, you can solve it by having the lender of last resort basically backstop all deposits. That would solve the problem. The other one is to basically become basically a full-blown sort of a working capital cash management trading floor and operate it that way. I mean, there are some known sort of operating models that gets to that. But, at the end of the day, one illiquid position in the oldest money market fund basically collapsed the entire money market fund market in 2008. So I'm not sure, even if we can, devise the perfect solution, we could basically say that this market is 100%, bulletproof. I think when trust is lost, and as simple as that. You just have to wait for it to come back. And usually it doesn't come back. Usually someone very big, very powerful, like a central bank, has to step up and say, well, we're backstopping. But, that's my 2 cents.
Yeah, I mean, I think, and I alluded to this briefly, and I'm not sure what the broader question here is, but I certainly found it interesting, the irony of transparency through all of this. You would think that increased transparency would mean increased stability, but we saw a market act irrationally, which is not unusual, and maybe I shouldn't have been so surprised, but we saw the market act irrationally after Circle was transparent about where exactly our reserves, some of our cash reserves, were held. That doesn't change Circle's position on being transparent with exactly where our reserves are. And in fact, we've moved our reserves into a BlackRock MMF to be more transparent around where they are. But it is, kind of a philosophical question here around, a coin that does not disclose its reserves is able to weather that just due to the sheer opacity. And yet we've seen other stable coins purport to be fully reserved, and then some on-chain accounting saw them to be not. So there's I think that question here too.
Yeah, I think it's like coming back to like the history with TradFi. That's the even though you may be fully disclosing the stability or the stability and the quality of your assets on the, say, for example, for a bank, you still will be exposed to the abrupt, like the short, maybe short dated, the disruption of the users, like kind of like the bank run type of the crisis feeling, right? And in order to counter it, the traditional banking system holds capital and also the backstop of the liquidity by the central banks, as Caroline mentioned. So I mean, it really cannot be solved by just one single measure of disclosing the full quality of your qualified assets, but also it must be like multi-layered in order to like secure the stability of the whole financial system, like including the backstops by the regulators and the central banks, but also by the other measures, the liquidity measure. I mean, you may see like so many the regulations or the regulations imposed by the internationally agreed by the BIS under the BIS regime, that it's not only for the quality of the assets, but also it's for the adequacy of the capital and also the access to the liquidity and so forth. So you have like numerous the formula to certify your bank is resilient against many kinds of risks.
Massimo?
Yeah. No, I take the advantage of Shinichiro question to reason a little bit to the concept of point of failure. Here we are in a conference that has always been between computer science and finance. In computer science, we have the concept that a robust system can have some points of failures as long as they are not central points of failure, and the system remain resilient. At the same time, in the financial system, we have the concept, we have traditionally the concept that having the possibility of some failures was also important for computation and made the system more resilient. For some reason, what we are noticing is that it seems that we can no more stand a bank failure, and that's an issue, So if we are forced to bail out every bank, including those that actually had poor risk management properties. I'm just saying that the system is no more resilient in general, So it's something needs to be changed. Maybe there are very good reasons why none of these banks should be let default, but in the current system, it doesn't make sense that banks, in a sense, can decide about the risk and the risk they take, and then they are protected from default. So my point is that the system may be no more resilient if it doesn't accept to have some points of failure that can actually fail and the system survive. Just an observation.
Okay, any other comment or? So I think it's quite late here. I wanted to thank again Massimo, Ali, and all the panelists. So let's give us ourselves as well last round of applause. And appointment tomorrow. The program is on the web. Thank you, everybody.
Thank you.
Thanks very much.
Thank you very much.